The sharp rise in long-term interest rates on government bonds is at the forefront of economic news. And in particular, the speed of this sharp rise in interest rates is striking. Indeed, in less than a month, US 10-year yield rose by about 40 basis points to 1.5% at the end of February. Other markets, with the Eurozone and the United Kingdom in the lead, followed suit, albeit that the rise in interest rates was slightly less pronounced in the Eurozone. Now, despite these increases, global interest rates are still at very low levels, certainly in the case of the Eurozone. And real interest rates, importantly, adjusting for inflation expectations, are still in negative territory. In fact, it is mainly real interest rates themselves that have risen, rather than long-term inflation expectations. The rise in interest rates does therefore not necessarily mean that inflation expectations are derailing. In fact, long-term inflation expectations in financial markets still remain relatively subdued, and in the Eurozone, even below the ECB's inflation target. In other words, it is rather developments in the real economy that are causing some nervousness. On the one hand, the rollout of unprecedented strong fiscal stimulus in the US is providing a strong tailwind for the economy, but on the other hand, fears are slowly emerging that these programs may be excessive, creating inflation risks which, in time, may require central bank intervention. In both scenarios, real interest rates will rise, either because of better growth prospects or because of rising risk premiums. And the rest of the world follows the US. Meanwhile, economic outlook continues to improve slightly. Better than expected initial estimates for the fourth quarter GDP of last year suggest that economies are gaining economic resilience against the COVID crisis. The extension of lockdown measures in Europe may therefore not necessarily be as damaging as it was during the devastating first wave. Vaccination campaigns should finally bring the pandemic under control and allow gradual normalization and economic recovery. But until we get there, the economic recovery will be less synchronized than initially expected. Wide variations in the availability of vaccines mean that the economic outlook is diverging more and more. And as a result of very intensive vaccination efforts, the United States can already look forward to an early gradual normalization and an economic recovery. For the Eurozone, we expect a recovery to gather momentum only from the second half of this year and continuing into next year. For the US, we have therefore revised our growth forecast for 2021 upwards to a level of 6%. And this means that the pre-crisis GDP level will already be reached in the first half of this year. Based on our growth forecast of around 4% for this and next year, the Eurozone will not reach the pre-crisis level until the first half of 2022. Nevertheless, caution is still warranted. The expected economic recovery will depend on the success of the global vaccination campaigns. And the race between vaccine and virus is not over yet. Downside risks remain. And it is therefore crucial that the vaccination is stepped up, particularly in Europe. Faster vaccination can reduce the risk of structural damage to the economy. Back to inflation. This will remain a key concern in the coming months. We expect a temporary but significant surge in the headline inflation in the coming months. This is not necessarily due to structural price pressures, but rather to a number of technical factors, in particularly the volatility of oil prices and some cost push effects. Financial markets are already taking these developments into account, and also central banks have announced a look-through stance. Apart from that, we do expect underlying inflation to pick up in the Eurozone, but it will remain below the ECB's inflation target also in the coming years. After all, large output gaps provide scope in terms of production capacity for additional growth without strong inflationary pressures. For the United States, we assume that a pickup in the energy prices could temporarily lift inflation to 2.6% in 2021, after which it should fall back to slightly above 2% in the period 2022-2023. This level is noticeably higher than in 2020 due to additional fiscal stimulus and the Fed's greater inflation tolerance, but still fully in line with its inflation target. Finally, a word on policy. Fiscal and monetary policies continue to put their mark on economic developments. This is tangible, among other things, in the unprecedented strong fiscal stimulus provided by the Biden administration and possibly also in the future infrastructure investments. And in Europe too, there remains room for a proactive fiscal policy. As the reins of the Stability and Growth Pact are kept loose via the escape clause, there is room for expansionary fiscal policy. Together with the Next Generation EU Fund, this could provide a boost for growth, although fears of too little too late appear also here. As for monetary policy, it is waiting for the response of the central banks to the recent real interest rate increases. Here, a first moment to watch follows after their policy meetings later this month. In short, financial markets have significantly adjusted interest rate expectations. The growth outlook has improved slightly, and we can assume a temporary higher inflation volatility. And against this backdrop, fiscal and monetary policy clearly remain in play.